Okay, we are live. Seeing everybody starting to jump in right now, whether you're streaming in from YouTube, you're streaming in from LinkedIn, or just directly from StreamYard. Welcome. Definitely, as you're entering into here, just say hi. I know some of you guys have already put questions in for the day since this is the Ask Chris Anything thing. As long as it's about money, okay? Do not ask me for marital advice or dating advice. I am not one of those experts. I know Danielle said, to put in hair advice because I don't have enough hair to even worry about giving you good hair care, tips or makeup tips. That's not what I'm here to do. Definitely anything to deal with money, investing, financial freedom. It can even be debt. I had to pay off over $1 million debt and so forth. Definitely welcome those. So definitely, as you guys are popping in here, I know some of you are live. Others will be watching this later, the recording. Definitely say hi here. Tell us where you're from. Now, as you're doing that, understand too, it does take on this StreamYard platform, takes about a minute for me to see these live questions. So be sure to put these in. I know there's several we already got to address here today. But as you're doing this, I want to kick this off, right? I want to kick this off for those of you that I know there's a few that are probably newer that may or may not know me very well. And so I want to talk about where I'm coming from, right? Because if you're expecting to hear the same old vanilla advice about, how to slave and save away, as I like to say, or basically save everything, spend nothing, save it forever, and hopefully someday you'll have something, especially if you put it in the stock market. This is not that kind of event here, right? This is not the kind of chat that we're going to have here. I used to be of that mentality. I actually bought into that drank the Kool-Aid and everything, right? I was part of that financial advisor cult, where I was teaching that very same thing of that financial freedom was all about being debt free and saving your way to wealth. And then after about 4 years of doing this, I did this, I actually entered that industry just after 9/11. And after 4 years of doing it, I sat down with my dad and this guy, I mean, he had paid off all his debt. He was saving money. I mean, this guy was a strict saver. I mean, this guy was the kind of guy that was so cheap, didn't want to spend money on anything. Very much like his parents who raised him during the Depression, right? And so as a result, I looked at his numbers and I said, okay, Dad, you're 61 years old. If you want to retire today, you've only got enough money to last about 5 or 6 years. That means you pretty much have to die in about 6 years before you run out of money. If it weren't for Social Security, of course, right? Which would kick it eventually, but he was too young for Social Security at that point. And he's like, well, that's not what I want to hear. What do I do? And I didn't have a good answer for him. I don't know. You've done everything I teach as a financial advisor. Guys, it was that kind of woke me up to realizing that this, guys, people just like him, people that work so hard their entire lives, save for decades in mutual funds and stuff like that, still never get to that point of real financial freedom. Yes, people have been able to retire. Yes, they've been able to live on very strict, limited budgets in retirement. There's even a few that actually live well in retirement. Unfortunately, they did not make their money from investing and saving away. They usually made their money from having other investments like real estate. They had other things like businesses that they might have sold off for millions of dollars. And then they put it with a financial advisor who basically just guesses, and has no clue what's going to happen in the stock market. But they hope they don't lose too much money when it goes down, and they hope they make some money as it goes up. And that's the real issue that we're dealing with, right? Is that we don't have the time in our lives to waste away hoping that some strategy is going to work. That's why people are living on hopium, right? You're smoking hopium, hoping that this is going to work out. On top of that, you got right now, people are getting more and more in a serious situation of cash flow crunch, right? Because everybody's talking about future planning, but what about today? What about present day planning? Who gives a crap about your retirement if you feel like your money is now getting stretched thinner and thinner because inflation is going up, but your wages aren't going up as much? On top of that, you had issues where, of course, interest rates have been going up too. So regardless if even you're not trying to spend or do anything, if interest rates are going up in any way, shape, or form, if you're trying to buy a house or anything like that, we have student loans coming back for repayment that there's now like over a 9% default rate for student loan holders. I mean, all this is happening because, again, there's a cash flow crunch, not because people were ridiculous spenders, although there are some of those too. It's because people have not been prepared to have cash flow addressed right now. And so this is the kind of questions I want to talk about today, right? Is what are your burning questions? What are the things that are, eating you alive? The things that are keeping you awake at night? Because I'll tell you, like in my own life, because when I stopped being the financial advisor, when I broke away from that, I started looking for people that actually were financially free. And a lot of them were in real estate. And by the time I was 28 years old, after I quit being a financial advisor, after I rejected all the 401k and IRA philosophies and everything else, I was able to retire when I was 28. But then the recession hit, and I went from millionaire to over $1 million in debt, right? Because basically I was just gambling at that point. I thought I was amazing. I thought I was awesome. I thought nothing could go wrong. And that was my folly. That was my weakness there. And so as a result, between that and starting a new business, which of course was taking a lot of money too, at the same time when the recession hit, I had over $1 million in debt that I had to work on paying back. And I didn't go bankrupt, but man, there were some days I wish I did. It would have been way easier to go bankrupt than it was to try to dig out of that hole. But eventually I did, guys. And eventually by the end of 2016, I was able to be financially free the second time when I was 39 years old. And just so you know, over the last 15 plus years, as I've been teaching people how to improve their cash flow, how to create more passive income. So they work because they want to, not because they have to. You give it to be work optional. As you taught people how to find creative ways to pay off debt, find ways to save on taxes, find ways to ultimately have more cash today so you can have the life that you want today and in the future too. So that's kind of the summary of the things that we talk about. Yes, we talk about infinite banking. I know there's some questions that are coming in about that. So anyways, love to see these questions. I'm done talking about the state of the world because there's no doubt there's a lot of uncertainty. The stock market is way overvalued. And as a result, there's a very high possibility you might lose a lot of money in the stock market over the next few years. And just so you know, just because the markets come up almost like making up for those losses, the same thing happened in 2020. When March 2020, the market tanked, it came back up in August of 2020. And then all of a sudden, 2020, 2021, 2022, all the way to March of 2023, we had a down market where people lost half their retirement. In some cases, more. That's one of the things that actually happened to my dad. It's because the mutual funds that he had selected as work actually did worse than the stock market. By the way, if you have a 401k, do you know that you actually usually have higher fees and they underperform the stock market, which means you make a lot less returns despite the match. You might be barely able to break even to what somebody would do outside of a 401k. Anyways, that's enough there because I'm going to go on so many different rabbit holes. I want to focus on your questions right now. So let's do this. So, all right. I'm going to jump in. Russell, he had a question going here. So he says, do you invest in working interest in oil wells or minerals? If so, who's a trusted operator to work with? So why don't we just hit it right out of the gate? So going beyond real estate, although we do a lot of things based on real estate, when I'm looking at oil and gas, I like to have things that are backed by real estate. Working interest, just so you're aware, for those of you that haven't heard of working interest, what that means is usually you're the speculator, right? You're usually the one that's going in, you're having to start to do all the excavation, drilling the wells and everything else. So you're going into a partnership, right? You're going in this business partnership. The great thing about having what's called working interest when you're doing this kind of speculative venture with oil and gas is that you get to write off a significant amount of your investment. So for example, and I'm just generalizing because every company might have there's different operators out there, but they might say, if you invest 100,000 into that investment, you can write off $80,000 off your taxes for that 1 year. Plus, if you start making returns, if it's oil and gas related, like royalties and whatnot, about 15% of your income does not get taxed. And when I say 50% of your income, like the income from the oil and gas investments. So Russell's asking, do I invest in that? And the answer is yes. I do have a few investments, not so much in working interest, although there's occasional that I do look at. Most of the time, I'm just going for mineral rights, right? Just things that are cash flowing already. They've already found the oil. There's not as much risk there. That's the kind of thing I do. And Russell, just so you know, the operators that we use, usually we reserve just for our VIP clients, our consulting clients that pay us. And so I believe, actually, I know you and I have talked before, but I think you might have talked to us before about how to become a client that way. If you qualify, that's a big thing too, because most of these you have to be an accredited investor, and I think you are. But if you qualify, of course, that's one thing we talk about with our VIP clients. We try to keep that reserved for just them, especially if it's a popular investment. And I'll tell you, it can be very popular, with oil and gas, because people want to diversify not just away from the stock market, but even to diversify away from just normal real estate. So yeah, but I will tell you this, Russell, most of the people out there that you see in the oil and gas space, there's one or two categories they could fall into. One, they could be bad operators or inexperienced operators. I do know some people that have recently broken into this oil and gas space and have good marketing behind it that seem legit, but I wouldn't trust my money with them because they haven't been around very long. I like to see operators have been around for at least 20, 30, 40 years is my criteria. So when you're looking, look for that. And then two, the other thing is too, sometimes there's bad actors out there too. Sometimes there are people that literally are scammers. I actually came across one several years ago that they talked the talk. They had offices. You could go to their office. Everything looked legit. However, one thing that they did is when they sent their numbers on a particular project, their pro forma, right? When they sent their numbers, they were literally just copied and pasted numbers from previous projects. Sadly, nobody caught on to this, including myself. I didn't even notice it when I was looking at some of these projects, but they had literally just copied and pasted, even though they were very individual, different projects. Needless to say, these people are being sued, potentially dealing with jail time. So just so you know, in this space, not everybody's bad, of course, but there's a majority of people out there that you have to be very careful of. So, but yeah, that's why and I'll tell you this, I also, as a philosophy when it comes to investing, when it comes to certain operators, even if somebody has multiple projects, I had to tell my clients, especially with oil and gas, because this one particular guy was very, very good at selling people in, getting people excited, especially with oil prices being depressed lately. It's not as good cash flow right now, just so you're aware. The cash flow is not great, but it's still cash flowing at least, depending on the project. But this guy, he was selling people so much that I saw some clients that were trying to put in half their money in with him, even if it's spread among multiple projects. And I definitely, that's something I would warn against, is don't get overly invested with one operator, especially, no matter how good it sounds, no matter how many, even if it's the deal of the decade, as I would hear, or deal of the year. Definitely you don't want to buy into that. So good question. That's a great question. But yeah, if you have questions about that specifically, you can reach out to me personally and we could talk about it offline. But definitely that's something we do. Some of these specific operators that we recommend, at least or that I use, are people that I reserve for my VIP clients, so they get that benefit as well as being part of our group. All right, let's go to the next question here. All right, this was an email question. Oh, actually, here's one. I almost missed it here. From Ken. So Ken says, how do I contact you regarding selling insurance with your group? I don't get that question very often, but every once in a while lately, I've been getting that more often. Ken, I would just recommend reach out to me individually. Chris@moneyripples.com is my email. That's something we could chat about. Are we looking for people to do that, to work with our people that have been coming to us? No, not necessarily. I mean, we have a good enough team, but I have had people reach out to me recently saying, can you teach me how you do what you do? And that's something that we can be open to discussion and definitely find a way to see if there's a reason to work together. So great. All right, here's an email question. I saw this one coming yesterday. And actually there's like a series of 4 questions, but we kind of summarized it into this. It's like, how do I know I'm getting a good infinite banking policy that I can fully utilize? And how can I be confident I'm receiving the right guidance to maximize the benefits? I'm going to leave this question up for a little bit because I know it's a 2-part question, but it's kind of tied in with the same thing. If you don't know what I'm referring to when we talk about infinite banking, especially if you're new to this, whether it's to this YouTube channel, if you're watching it on YouTube or you're watching me for the first time, infinite banking is basically this tax-free, high-yield savings account using whole life insurance. All right. Now, whole life insurance is not infinite banking. Whole life insurance is whole life insurance. It's a permanent death benefit. It's permanent insurance. The difference with whole life versus term insurance is that whole life insurance not only has a death benefit, but it has this tax-free savings account inside of it. And the infinite banking concept, credit to the Nelson Nash Institute, that talks about this. The infinite banking concept is about using this money, like moving it in and out, the flow of money, using that in a way to essentially pick up more interest dollars. And the way that's the case, I'm going to take this off now. Here we go. And the way that's the case is that when you have this cash account, see, you can just withdraw money from your savings. You can do that, of course. You're fully able to do that, and you can withdraw most of that money out without destroying your life insurance policy. However, what most people will do is they'll say, wait a minute, I can also borrow from the insurance company. So I can leave my money alone. I don't have to touch it, but because it's there as collateral, just like if you had money sitting in a savings account in a bank, you can literally go to your banker today and say, can I get a secure line of credit against my bank savings account? And the answer will be inevitably yes, because here's what they'll do. And this is what they did in my situation. I remember just trying this out for fun. I went to my bank account and I said, listen, or my banker, the bank, the credit union I was with. And I went to them, I said, can I get a line of credit against this $25,000 just sitting in the savings account? They said yes. And so they set up this line of credit. And it was an open line of credit, just like you pull out, like if it's a credit card or sort of kind of like credit card, or more like a home equity line of credit, right? So if you don't pull anything out, there's no payment. When you start to pull money out, then you have a minimum monthly payment. They charge you interest on it. Now the interest, right now might be around like 4 or 5% on something like that, while you might be earning on that point nothing percent in your bank, right? Some people might say, well, what if I did with a CD? Yeah, you could probably do a CD, but they're going to charge you more, significantly more than what that is. So I did that. I had a $25,000 line of credit. Then I pulled out all 25,000, put into my new business. I thought, let's just see what happens here. And lo and behold, I get this payment for like $150 a month, or actually it was about $200 a month with the bank. So about $200 a month, very low interest. But again, at that time, I was earning 1.5% interest on my money in a savings account because they were paying more back then. And I thought, okay, this is kind of cool. I'm paying 4%, but I'm getting paid 1.5%. Now, not great, but it's an option. But with life insurance companies, they give you better terms because where they do have a spread, they might charge you more. They might charge you the same as whatever they're paying you. It's very little. It's almost the same rate. And this is what happens when you pay back on a loan. You pay back with simple interest, right? Which is kind of cool. But they're paying you on your money because you're not touching your money at all. You're just getting the money from the insurance company. You're taking it out of their pocket and using it. They're just saying, hey, we're going to lock up your cash. So you can't pull out your money too, so that we know our money's safe. You pull out your cash, you can use their cash, whatever you want. Now, they'll of course charge you interest on that money, but they're still paying you compounding interest on all that money in there. So say you had 100,000 in there, you're earning 6% a year tax-free, because that's a tax-free return you're getting. You now made 106,000 that next year. But guess what? The year after that, you don't make $6,000. You make 6% on 106,000. But now you have 112,000 and change. Next year, you have 118,000 and change. The next year, you have 125,000, and it compounds and grows, right? But when you're paying back, if you want to pay it back, which by the way, there's no minimum monthly payment, you pay it back however, whenever you want. But if you do use the money, say you're getting a return from that 100,000 say you put into an investment, it's paying you 10% a year, you take that money, that 10,000 a year, put it towards the loan. And what you're doing is you're paying the loan balance down. So you get charged less and less in interest, which is simple interest, while they're paying you compounding interest and it goes up. So you actually make a spread higher. You make more interest than what you pay them, even though their interest rate could be a little bit higher. That's the secret. That's what makes infinite banking cool. And the thing is, some people will tell you can use it to buy cars, buy houses, or whatever. I typically don't do that if I can get low interest, even right now, even student loans. I won't do that, even though some people do use it in replacement of student loans. But I'll use it whenever I can get cheap money from the bank. I use the bank. When I can't get money from the bank, that's when I use my policy. So if I go buy a real estate property, rather than just trying to throw all of my money to buy a property in cash outright, I might instead still get a mortgage from the mortgage company for getting that property, but the 20% down payment, I'll use my cash from my policy to put as a down payment. And then I take the cash flow and pay it back towards it. And what happens is this: I make extra money and interest there, but I'm still making money on my investments. I make money in two places at the same time. So even if I was making a 10% rate of return, I might make 11 or 12% total return, but by using that strategy instead. So that's kind of the basic philosophy. So going back to this question, right, which is, of course, this is the general infinite banking policy. Now you guys know this. If you haven't heard of it, that's what we do. He's like, how can I know I can fully utilize it? How can I be confident I'm getting the right one that maximizes its benefits? This is the hardest thing for you, right? How do you know you're getting the right one? How do you fully utilize it? Well, fully utilizing it is one, we're actually doing for our people that have policies, because we do write these in-house. The reason I did this because I couldn't find anybody I could trust to do it the right way that I would do it for myself and my family. So we brought it in-house to make sure we get the max ROI possible. Hence the name Max ROI Infinite Banking, which we've trademarked. Now, the way we do that is that we minimize the cost. And this is to answer your question here, is how do you do that? How do you know you get the maximized benefits? Well, I don't focus as much on the death benefit. I still tell people get death benefit. We might get a blend of term and doing different things like that to get more death benefit. But with these kind of policies, the death benefit, the higher the death benefit is, the more it costs. So I try to figure out, based on how much somebody wants to put in every year, what's the lowest death benefit needed to allow that money to go in and still stay tax-free. That's the secret. So then we minimize the costs coming out, those insurance costs coming out of the policy, because remember, there's still a death benefit you're paying for. It's kind of like people that buy term and invest the difference. The difference though here is that the costs go down over time, where term insurance costs will go up over time as you keep renewing it and doing that sort of thing. And so we minimize those costs so that you actually have more money right from day one. So to answer your question, can you be confident you get the right one? The best way to do it is this, is to get the numbers from those insurance agents, right? This is the problem I see all the time, is that there's so many insurance agents that will maybe show you the numbers when you're doing a call with them, but then they'll withhold them. They won't give them to you. Why? Because they don't want you to shop around. I fully welcome it. I fully welcome people to shop our numbers around. We always give our people their numbers to see and play with. What I guarantee is this: no one will beat our numbers. They might match them. There have been a very few, like I'd say like 1%, maybe 2% of the time, people might match our numbers, but they'll never beat them. Because again, we always try to find the right companies. We're independently brokered with different companies to find what's the best one for that situation. And so we always pull the levers to make sure we minimize those costs as much as we can so that you have more in that tax-free savings account versus going to pay all for your death benefit, right? That's the thing. And so again, we want to give you more cash, because the more cash you have to use now, that money can then be used to create velocity of money, create more velocity of creating more wealth with that money. Not to mention, it's a great place to store money. That's better. You have better return than your bank will get, tax-free, and it's 100% protected from lawsuits and creditors, right? So that you can make 6% a year on the money that's actually there in cash, and it's protected from lawsuits and creditors, no matter if you have millions stored there. That's huge. So anyways, that's a whole nother thing. If you ever want to know more about that, you can always go to our website, moneyripples.com. There's a whole infinite banking section on that. But to answer that question again, how can you be confident you're getting the right guidance to maximize its benefits? Reach out to us, right? Reach out to us. Feel free to reach out to others too. But you'll see pretty quickly if it's apples to apples and they're not cheating or lying to you, putting in the same amount of money in the same amount of years and everything, you'll see that you'll have more cash in our policy than any of those other policies. All right. Another one. Excuse me. By the way, I of course have more people, more questions coming in. So feel free to keep putting more questions in. I have a few more questions here, but if you have some let me say that again, more follow-up questions or things that are popping in your head now. Again, especially these burning questions that you feel like might help you in your situation today, put them there. Put them in the chat. We'll answer them. All right, move on to David. It says, do you prioritize new cash flowing investments or paying off existing debt with your life insurance cash value loans? Okay, cool. We're going with this life insurance thing, right? This is a great one. This one does depend on the situation. Which debt do I pay off? I'll tell you this. The only debt I usually consider paying off with life insurance is probably going to be high interest, things like credit card debt. That's something I would definitely prioritize. But I don't look at it most of the time, I'm not looking at from what's your interest rate you're being charged. I'm looking at what's your monthly payment. So pretend with me on this just for a second, right? Let's just say that, and trust me, there's not many investments you could do this, but let's just play with this example here. Say that you have a $10,000 and you're saying, do I pay off debt or do I invest it? And the answer is the same for me, whether I'm using my insurance or not. It's pretty much the same. But $10,000, do I pay off a $10,000 debt or do I invest this $10,000? Now, I have a strategy I created back in the day because I was literally asking these questions when I was going broke in 2008. And I was trying to figure out what to do. I created this concept called the cash flow index. And the cash flow index is you take the loan balance, this individual loans or the loans that you have, take the loan balance, divide it by the minimum monthly payment, and you'll get a number, right? You'll get an index. So say, for example, that you have a $10,000 loan and it's a $200 monthly payment. Well, if you divide those into each other, you get a number of 50, right? Now, I did it this way because I want to make easy numbers, because what I used to do is take the rate of return on that money. Because think of it this way. If that number, let's say you take 10,000 and you free up $200 a month by paying off that debt, that's $2,400 a year. 2,400 into 10,000 is a 24% rate of return. Let me ask you this. Do you have any financial advisor that will tell you, I will guarantee you a 24% rate of return? The answer is pretty much no, right? Now, at the same time, could I invest that money and make that much money? And again, if cash flow is my number one thing, like if I'm tight month to month, I'm going to prioritize the debt, especially in this case, because I know if I invested 10,000, even if I made a 10% rate of return in a real estate investment, I'm only making about $1,000 a year versus a guaranteed 2,400 a year, 200 bucks a month by paying off that debt. So if cash were tight, if I needed more cash flow freed up in my situation, I'm going to go for the debt. That's how I view it. Now, what if cash flow isn't tight? Maybe I'll look at the number differently. Now, I'll tell you with the cash flow index, there's a whole nother thing there. The lower the number, basically the better the ROI of paying off that debt, the better it is. I just use the cash flow index as that number to make it easy. So I'm not always calculating ROI, but this is where it came from. It came from me calculating, should I invest the money or should I pay off debt? Again, I was tight on cash, so I was prioritizing what's going to improve my cash flow the most. But I get a lot of clients that their cash flow is okay. Like they don't really have that situation. They're just figuring out what's the best use of my money. Well, let's just say that $10,000 loan, going back to the same situation, is 200 bucks a month. Let's just say it's a 6% car loan. Well, one, I'm probably not going to use my life insurance to pay it off because my life insurance interest rate, yeah, it'll be about a little over 5% for that loan rate. It's not going to save me a whole lot of interest there. Plus, it puts a little bit of drag on my policy, creating better returns. And so I'm probably just going to leave it with the bank at 6%. However, if it's only a 6% loan, I know if I can invest that same 10,000 bucks and make over, and this is key, because I mentioned this a little bit earlier, I can make at least 3 or 4% a year on my 10,000, I'm going to beat that 6% car loan. Why? Remember when I just mentioned earlier in this conversation about that simple interest that you pay on loans versus the compounding interest you make when the money's in savings? They're not the same, right? If you ever do a calculator, if you go online, like if you play around with like a auto loan calculator or just a loan calculator in general, and you put in that $10,000, in fact, let me just show you guys. Freak, I can do that right here, can't I? I'm going to show it to you because this is a big deal, and this is why I look at all these multiple factors. This is also why a lot of people just say, "Hey, Chris, can we coach with you guys to learn this stuff?" Yes, you can. I'm not saying you guys have to, but I'm gonna, obviously throw that out there if that's the case. All right, so let me share my screen so you can see it here. All right, loan calculator. Here we go. Or the Joker say, "Here we go." All right. So here's a $10,000 loan, right? So say it's, loan terms, like you have 5-year car loan, you got 6%. Look at that, almost 200 bucks a month, right? Maybe it's a little less than 5 years you got left. In fact, I'll even do that. So let's just see what, close enough. All right. So anyways, if you're paying about 200 bucks a month, you're paying over the life of that loan about 1,500 bucks of interest, right? You see that right there? So you pay a total of payments of 11,560. That means 1,560 is interest. The question is, if I had $10,000 to invest and I don't need cash flow, I'm not in a cash flow crunch situation, could I do better? So watch this. Let's go over here to an interest calculator. I'm going to make it 10,000. We're not adding anything to it. It's just 10. Oops, that did not turn out right. 10,000. And actually, let's go with this 5% interest rate. Let's just say I only earn 5% over the next 5 years. I'm earning a 1% less on my money. Watch what happens. Watch what the total interest comes into play. Not what it says right now, but what it says. 2762. Remember the last one for paying 5% on that loan was 1560. Why? Because you're paying down principal and interest. Less and less gets charged in interest over the loan. But here with the 10,000, it compounds interest. It grows by more and more. When you see it like grow, you saw like 10,500 next year. That was 11,025 and 11,576. You notice it just keeps going up more and more, right? It compounds more. That's the difference. So watch this. If I put in 3%, watch how much interest there is. 1592. Remember when I said 1560 was how much you're paying in interest? Notice 1592. So you're making, as long as you make at least half the interest rate over a 5-year loan, and this is even more so with a 30-year mortgage, you don't even have to earn half the interest rate. It's a little less than half. So if you have say a 4% mortgage, you only need to earn about a 1.8 or 1.9% in a CD with the money you could use to pay off your house to at least make the same interest as what you would get charged paying your minimum monthly payment for the next 30 years on a mortgage. That's the difference. So this is why I tell people, like, look, you're in the same interest rate. Say you earn 6%. Boom. Even though it cost you 1560, you still made another 1800 bucks on top of it, 3300. What if I made 10%? Look at this, 6100. Do you think I care about the 1560 if I can make 6100 bucks? No, right? That's the difference. So again, if you're not in a cash flow crunch, going back to, what we're talking about here, if you're not in a cash flow crunch, then I look at that. I say, well, let's look at the interest rate a little bit. Let's see what it's doing. Because if that loan I could pay off, I could pay off the insurance loan. But remember, the insurance loan is worth the same way as a bank loan. That's the one lie that's taught out there. They keep saying, oh, don't use the banks, use the insurance company. Well, if I have a 4% loan rate, which by the way, I have a 3.99% loan rate on my auto loan, why would I get a 5.3% loan using my life insurance? I'm just going to pay more in interest. There's no reason to do it. The only argument I've seen that's good reason is people say, well, you don't have a required monthly payment on your credit report, right? You're not forced to make that payment or you hurt your credit. That's true. Like with insurance companies, it's a private loan. There's no monthly payment. They still charge you interest, but they don't require to make money or make payments. Kind of like a student loan that's in deferral. It's very similar, but they still charge you interest, right? So again, if I can get bank money for relatively cheap, and I think for me, it's like roughly like 7 or 8% or less, then I'll just use the banks. But if it's more, then I use life insurance. So David, to your point, do you prioritize cash flowing investments or paying off existing debt? If the existing debt is higher interest rates, I'd say especially if you're going into double digits, yeah, could be a great strategy to use for your life insurance. Otherwise, I will prioritize cash flowing investments. And I do this only after I've already built up significant reserves in there because I'd rather keep more of my cash, my liquid emergency savings inside here earning 6% tax free than in my bank, which just lowered my interest rate to a 0.05% on their savings account. And that's taxable. That means I make 0.05% and they still tax me on that money, which means I might walk away with 0.03%, where instead I could keep it somewhere at 6%, making almost 20 times the interest tax free after you factor in taxes. So that's why I'm very picky about how I use my life insurance. I keep most of my cash storage there. But yes, if I've used up all the money out of my bank accounts, my savings accounts and checking, and now all I have left is the money in my life insurance, that's the next place I go to then start making that double dip on my returns. I know I might have went deeper than you wanted to go, but there you go. All right. Let's see. Oh, Danielle, that did post. If you want to see, there is a YouTube video on our YouTube channel about the cash flow index. We want to learn more about that. If you are at a place where maybe debt is kind of the main thing that's feel like it's crippling you, watch that video. Like look up that cash flow index on our Money Ripples YouTube channel. Great rabbit hole to go down, but it's very effective. That's what helped me dig out of my $1 million debt hole, was using that very strategy, prioritizing which one does it better. In fact, I just helped a client recently where she was able to get equity out of her house, and we used that money to help pay down debt. We prioritized it, freed up like $4,000 a month. It was huge for her. Did we invest it? Not at all. We just paid off the debt, using that cash. Did we put it through an infinite banking policy? No, we did not. We just literally took the cash, paid off the debt, freed up the cash flow. Now we're working on stage 2 because it now improved her credit score to then do a refinance of her house. So then we could pull out more cash, and then that's the money we invest. And yeah, we might end up doing a smaller policy, but no, I don't agree with running it through infinite banking, running all your money through an infinite banking, life insurance policy. That's a big sales tactic that's being taught out there. Completely, in my opinion, false from more an investor perspective. Is there a reason for it? Yes. And you can run some money through it, but not throwing all your dollars through an infinite banking policy. That's not the case. Speaking of which, we got another question on that too. By the way, any more questions coming in, make sure you put them in because it does take a minute for it to show up. Kelly asks, what do you think about using the infinite banking policy that you recommend to use towards working with your team or cashing out some stocks to work with your investment professionals? Oh, okay. Now I just got it. I was thinking team. Sorry, Kelly. I was thinking when you said working with a team, I thought you meant like you have a business and you're talking about your team there. I was like, oh yeah, definitely using infinite banking for business purposes. You get to write off the interest that they do charge you. I love it. Oh, you're talking about what about using the infinite banking policy you recommend towards working with us at Money Ripples? Okay, or cashing out some stocks to work with us as well. Or yeah, I'll tell you, it can definitely make sense. Depending. I mean, here's what I often will have people do, especially because it's so short term. Let me just talk about what it looks like working with us. We do one-on-one coaching, right? If you guys would indulge me here, I'll tell you what we do. This is not a fit for everybody. In fact, many of you watching this probably won't even qualify to work with us anyways. We'll probably tell you it's not a good fit. But for those of you that is a good fit, especially if you've got at least 150, 200 grand in cash that you could be using to invest, whether that's maybe debt equity sitting in properties that maybe we should be selling those properties because the cash flow stinks. It could be money just sitting in savings, or could be sitting in life insurance, right? It could be in stocks, mutual funds, things like that. Anything besides your current employer 401k, if you're an employee, that is. If you've got cash you could be using to invest, then that could be a good thing. So usually people have to have at least 150 to 200,000 for us to feel like it really makes sense, where you can diversify and do some things. We work with you one-on-one, right? That's the one thing that's different. We are not investment advisors. I'll just say that, kind of go on with that question. My investment professionals, we are not investment advisors. We work as consultants. We don't cross the line where we say, you should invest here, you should invest there. We don't do that. However, we do come close enough to at least help you feel more confident to make a decision on your own. And we do that by helping you create a customized game plan to get you out of that rat race, right? To get you to the point where you're work optional, where you have enough passive income coming in to pay for your monthly expenses, right? So then you go to work because you want to, not because you have to. And I know many of you, you don't want to stop working, right? You love what you do, especially if you're a business owner. You just want to have the freedom to be able to say, I want to take a month off, and I know that financially I'm going to be okay because my family's taken care of. That's why we don't want to just get you financially independent. We even go beyond that for some people too. In fact, that's always the case. People always want to go beyond just barely paying their bills, right? So coming back to that, working with us, should you cash out stocks or use life insurance? That's definitely an option. I've often just recommended people just using a credit card, and I know that sounds horrible, but here's why. Because one, we will never take you on as a client unless we know for a fact we can help you make more of that money back within a year. And if you do the math on a credit card, if you pay back a credit card within a year, the interest charge is pretty negligible anyways. But it also means that we can strategize, because maybe we will say, if you have the very first meeting, we actually address cash flow in that first one-on-one meeting we have, usually within the first few weeks when somebody signs up. And so we start looking at all the cash flow. We look at everything, right? We're looking at all your finances there, seeing like where can we pull the most triggers to, essentially create the most cash for you right now. What's the low hanging fruit to give you the best cash flow benefit? Where are some passive investments you could be doing? Things like that. By the way, just so you know, if you want to know how to qualify for that, we do have a pre-qualification way to do it. We have that passive income calculator on our website. You can see it right there, moneyripples.com/passive-income-calculator. You can just find out right there. Generally, if we get a number of at least roughly about 15,000 more, assuming you fill it out correctly. If you jump off because you don't fill it out, you're not going to get an accurate number, right? If you don't put in the numbers right, you won't get an accurate number. So be sure to fill out the whole thing so you can actually get an accurate number over your situation. By the way, even if you're less than 15,000, we still have things like the Wealth Accelerator Academy. There's still infinite banking, things you can do right now, start benefiting your life. So anyways, that's the passive income calculator, right? So we're going through those, we're looking at your stuff to really figure out how do we actually create at least that much passive income that you get on the calculator, right? So that's the big thing. So, give you an example. I mean, I've seen a lot of companies out there, they're charging like 40, 50 grand for one-on-one coaching. I mean, it's definitely, that's the standard right now in the industry. If you want to work one-on-one, especially if it's around passive income or investing, you're going to be investing at least 40 grand into a one-on-one personalized game plan. Now, we wouldn't want to take you on unless we make you probably at least $50,000, $60,000 in that first year, right? Which, by the way, is that a bad thing? If that's not just the first year, but that's ongoing year after year after year, because let's just say it's $50,000 you're able to make from that 40,000 coaching. Yeah, you net $10,000 profit. Cool. That's a good ROI, right? But on top of that, you're doing that year after year, and usually they're compounding your income too. So let's just say after like 5 years, you end up grossing about $300,000 because that 50 grows to 55 next year, then 60, 65, and so on, right? As you're reinvesting that money that you're making as passive income. Well, $300,000 from 40,000 one-time investment is pretty dang good. Just so you know, we're not even close to that. Our coaching is way less than that. So there's a lower bar of entry so that more people can get to their numbers more quickly. But that I just use that as an example because we don't take people on unless we know for a fact they can actually do that in their situation. I know some people don't believe that. Some people will literally tell you in 5 years, you'll finally make your money back. We're like, no, from the time you start investing, usually from 12 months later, you've more than made your money back at that point. Is it guaranteed? Not at all. Nothing is guaranteed in life, but we have pretty dang high success rate. I can't legally ever say 100%, but again, we don't take anybody on unless we know we can do it. The only time, and it's been very few percent of the time that people haven't done it, is because they literally did not invest. They did nothing. So that's pretty much the one way to do that, right? So anyways, working with our team, go back to your question there. Like, do you cash out stocks? Do you do different stuff there? It might just be better. Use a credit card, leave the stocks alone, leave the infinite banking alone. And then as we discussed, looking at your situation, we might say, well, what if we use your stocks this way? Because maybe there's taxes. We might want to work with a CPA to see, are there taxes if you pull out money? Some people want to pull money out of IRAs. A lot of people don't realize you don't even have to pull money out of IRAs or 401ks. You can actually move it into a self-directed IRA and then invest there in whatever you want. And it can be outside of what a financial advisor recommends, which, by the way, financial advisors can offer like this much. They only offer mutual funds, annuities, insurance. That's pretty much it, right? Some might say they can do stocks, but notice it's always stocks, bonds, mutual funds, and that's pretty much all they can offer. We get you outside of that, say, hey, there's a whole other world out here. In the world of real estate, yes, you can use your IRA or 401k to invest in real estate backed investments, things that have more security than stocks that go up or down, depending on what Trump says about tariffs and how he, pisses all over China, right? Or whatever Elon Musk decides to do, right? But like, we don't worry about that stuff, right? Because that doesn't affect our investments that we do. Even as we talked about earlier, the oil and gas space doesn't affect it. So hold on, trying to do that. But again, we can talk about those options, but often just say, use a credit card, because in the first month or two, if we think it's best not to have the credit card, we'll just have you pay it off, right? So hardly any interest will be charged in a month or two. Great question, Kelly. So yeah, definitely talk to our team about that. That's an interesting question. So Caitlin, how do you recommend to eliminate credit card debt? That's where I would recommend, Caitlin, on the cash flow index, using that. I know I'll go back to that video again that talks about it. This one's a great one to use. Here's the cash flow index. I said, take the balance of the loan divided by the minimum monthly payment. Pay off, you'll get that cash flow index number, right? So that 10,000 divided by $200 a month, like we used earlier, was an index of 50. But what if you had another $10,000 loan that was $500 a month? Maybe it was a car loan, right? Well, that index is a 20. You'll want to pay off the lowest cash flow index first. Why? Because think about it. You have two different $10,000 loans. Think of it from a common sense standpoint. If you need cash flow freed up, right away, and trust me, cash flow, in my opinion, trumps just about everything, even over interest rates. In fact, ignore the interest rates unless the cash flow index is a tie. Then go for the highest interest rate. But overall, just ignore the interest rates. Ignore what most people teach about debt that way, and focus on what helps you breathe easier month after month. That then you can take that extra cash you freed up to pay off more loans, right? And so that's what I did. So if there's two $10,000 loans, one's $200 a month, one's $500 a month, the one that puts me in a better cash flow position is the $500 a month one, the 20 index, the lowest index. I pay that one off first. In fact, just so you know, banks, when they're looking to give you a loan, look at the same exact thing. They measure your financial health, not off the interest rates. They don't even care about the interest rates of your loan. All they care about is how much is this taking out of your budget every month. And so if you can eliminate the one that's basically you can pay towards that debt, and that gives you the biggest bang for your buck, the biggest ROI on the money you use to pay off that debt. That's what the lowest cash flow index does. That's beneficial. Give you example, real life, examples of how we use this. I had a client where they were trying to qualify for a mortgage refinance, and by refinancing, they knew that they could get a lower rate. So they're trying to lower the payment, lower the rate. But the banker, the mortgage broker with that bank came back, says, no, you can't, because your quote unquote debt to income ratio is too high. Or in other words, your debt payments are too high of a percentage compared to your income. So I said, well, how much do you need to free up to get approved? They said, I don't know. They just said, pay off the $7,500 credit card. Actually, it was $7,600 credit card. They said, pay off the $7,600 credit card. I said, well, what's the payment on that one? Isn't that $75 a month? Yeah, it is. Well, do the math, guys. This is like an index of 100. That means for every 100 you pay off on it, you'll free up 100, but only $1 a month. I'm like, go back and ask him, how much do you need to free up per month for your debt to income ratios to work? So they asked him, and he said, you need to free up $41 a month. Now he told him just to pay off the credit card because that's what mortgage brokers do, right? They just look at whatever debts are like, well, if you pay off this credit card, you'll qualify. But I was like, no, no, no. I want to save you money. So I said, instead, I'm like, if it's only $41 a month, what that means is you can pay 4,100 because for every $100 you charge on this credit card, you pay $1 a month, which was amazing, by the way. So just pay towards 4,100 towards that credit card. Leave the other 3,400 alone. And so they did, freed up the $41 a month, just like clockwork. They qualified for the loan. So that saved them $3,400 that the broker just wasn't, just didn't understand, right? He didn't understand that. So that cash flow index is really a really cool tool. We've literally saved people like millions of dollars and millions of dollars a year cumulatively just doing that one strategy alone and figuring out how to do that. So, all right, I'm going to move to one last question here. And this one's with Roberto, one of our VIP members that we have with us. He says, hi, Chris. Approximately what percentage of alternative investments you've participated in have worked out, made money in the last 15 years? And those that have not worked out and lost money, what was the main learning from those? Ooh, that's a good one, Roberto. Man, like you're just going right for the jugular because most people are scared to even ask that kind of question. So I appreciate the candor. That's awesome. So I'll talk to you in my own situation. What a percentage of deals have gone awry? Let me count. It's only been about one or two. Well, and even then, even one of these, it haven't necessarily lost money. They're just in a legal battle with somebody who stole money from them. So they're still trying to get it in the court system right now. So that one might actually come back. If that's the case, I would say I've had one in the last 15 years lose money. Yeah, actually there was one that was close, but we were able to get our money back. It was an apartment deal too. So for myself personally, percentage of alternative investments, I would say it was definitely less than 10%. And that's pretty typical for even most of our clients too. Most of the deals that they've had available to them, it's probably between 5 and 10% that went awry, most of which were apartments. And that was because after 2022, when the Feds skyrocketed interest rates, which people all knew the interest rates were going to go up because they moved them up so high so fast, people couldn't respond in time. The values of those apartment buildings came crashing down. So when they had equity in those buildings, the equity just disappeared. So when people say, real estate's is risk-free, BS. That's complete bull, right? That's not the case. So there are people that definitely have lost money, mostly in that space. I mentioned like oil and gas. I mean, I definitely found out some of those things with oil and gas. I'll tell you the most investments that I saw my clients lose, there was like two in particular, right? Just two deals. They both came recommended to me from a financial advisor. So Roberto, getting your question about, what did I learn from those? One is I learned that I need to make sure that I find it through credible sources, right? The problem with both of those things is that the operator, man, that guy, as logical as he was in logical moments, when he was under stress, that guy became very irrational. And really, and that and the other oil deal that a financial advisor introduced me to and introduced some of my clients to, that deal that did go south. Again, both just either bad operators or one was a bad actor, right? In the sense that they were literally defrauding people. And now they're in the courts right now being sued with class action lawsuits. So both of those came from a financial advisor. Had it not been for that, there had been very few like apartment deals that of people we had them connected with different people in our network. Again, we don't ever make recommendations, but with people that we were connecting them with, very few deals ever went south. What's interesting though, is there's been times that I've told clients with people we've had in our network that said, hey, some of these deals recently, I would not, suggest looking at seriously because it's not in their wheelhouse of expertise. I'm like, I can't tell you what to do. I can't give you investment advice, but I know for me personally, they've offered the deal to me and I said no. Doesn't mean you should, but here's why I said no. And then some people still went and did that deal and then lost money. And so we've had clients lose money sometimes because they didn't listen to those lessons that I had already learned previously, and now they were listening. So yeah, I would say the good news is with our group, only roughly about 5 to 10%, maybe even 8 to 10% of deals went awry, of deals that were there, which is why we always encourage some diversification. But I'll tell you, that's way better than most groups that I know that have like their own. Somebody asked me about, I won't say their names because they're a good group, but They're very popular in infinite banking, and they have an investment group that's more group coaching. And somebody just asked me about it literally this morning about, hey, what makes you guys different? Or they asked one of our guys on our team about that. The one thing is, some of those people have had like 25% or more of their deals. I know one guy over, it was probably like 2/3, maybe 3/4 of their deals all went south, mainly because it was all one operator that he was using. So, and plus he's doing like ATM funds and everything. I warned people about ATM funds for several years, saying, hey, I wouldn't trust that, even though they're paying like 26% rates of return right now. I would stay away from those. And then bam, even though it was a good operator, things went awry and it went south. So just so you know, it's not risk free. Just like the stock market's definitely not risk free, but you can't do anything about it. There are ways to diversify in real estate investing to make it work well. So Roberto, I like this question. So what percentage? Like I said, maybe 8 to 10%, even if you include the last few years. Most of those have been in the last few years, mostly multifamily, like apartment buildings and things like that. But for me personally, like I've been fortunate. I started getting out of apartment buildings. I stopped putting into apartments when I saw the interest rates start to go up, especially when I saw that apartments were really hot. It seemed like things didn't feel right. So I always go for it. If it always seems like everybody's offering the same thing, I don't do that thing. I'll give you an example more recently. People talk about like Oklahoma City rentals, right? Turnkey properties in Oklahoma City. Oklahoma City, and even with apartment buildings, have been like everybody's talking about it. If everybody's talking about it, that's the time I never want to be in it. And I'm starting to see stress happening. People starting to realize, oh, this deal isn't as good as I thought, that kind of thing. And this is why it's so important for you guys that are listening, whether you're live here or the recording later. This is why it's so important to be a part of a community plus one-on-one attention, right? Because one, some of these deals may not even apply to you anyways. It's just a distraction, right? And you're spending and wasting so much time vetting and trying to look at all these different deals when really your situation doesn't call for those deals, right? That's why I don't like groups that just say, hey, here's our community. Here's a whole bunch of deals you can just go do, just pick and choose like it's a big buffet. It's much easier to say, hey, ignore this dessert table. It's crap anyways. Here's the table that you should be doing because this is going to be better for you, right? Like kind of getting your attention away from all these multiple buffet tables and just going to here's the 2 or 3 you should focus on versus these other 10, right? That's what we help people do on the one-on-one side. But then having a community too, where things are always changing and moving. Things that I might have talked to my clients about a couple years ago, saying like, here's a great opportunity. That opportunity might pass sometimes as soon as even 6 months later, where you might say, okay, that opportunity is gone. It's getting a little too hot. You might look at this other area instead. Again, we don't give investment recommendations, but based on the expertise and what I'm seeing, often I will share my insights, and you can take it or leave it, put it on a shelf. You can, use it to help to advantage. But I'll tell you that those that do, although I'm not 100%, I'm never perfect, and I can never predict the future perfectly in any way, shape, or form. Those that tend to stay close to our community, talking to each other and to us as coaches, tend to stay on a more safe path. So, and you're welcome. So, anyways, if you guys always have questions, feel free to ask us. Obviously, there's a lot of questions on infinite banking. You can always go to our website, moneyripples.com. You can learn more about that. We got videos on there you can actually watch. If you're like, hey, I want to talk to somebody about this, how does it apply to my situation? You check that out. Also, try the passive income calculator like we showed before, as well. You can use that too to see, what works there. So anyways, I think I got all the questions here. If I didn't, please feel free to reach out to us, and we'd love to be able to serve you guys. So thanks very much for tuning in. We'll see you later.